Welcome back to the deep dive. Today we're really digging into something critical. We're looking past the big flashy GPUs that get all the headlines.
Right.
And we're going to examine the company that's working deep inside the nervous system of this whole AI revolution.
We're talking about the fundamental plumbing, the stuff that makes sure all that incredible processing power can actually talk to itself without grinding to a halt.
Exactly, a catastrophic data choke point.
And we are, of course, talking about Marvell Technology, ticker MRVL, and it's a stock that has seen some serious volatility, especially here in late 2025.
Yeah, looking at the sources, it's trading around, what, $77, down 45 cents?
That's right. And that is a really significant drop from its 52-week high of over $127.
Ouch is an understatement.
Yeah.
When you see a quality name like that take that kind of a hit, you really have to ask, is something fundamentally broken? So
Right.
It's just a classic case of a high beta stock, overreacting to some serious macro fear.
And our sources show it's caught right between two big forces. First, there's this general AI fatigue setting in with investors.
That feeling that the monetization, the actual profits, aren't quite keeping up with this massive infrastructure build-out.
Exactly. And second, and this is the big one, it's the geopolitical adrenaline shot from these proposed 100% tariffs on semiconductors.
Okay, so to really assess Marvell, you have to sort of reset your whole mental framework.
You do. While a company like NVIDIA, they're supplying the massive GPU brains that run the AI models, Marvell is providing something else. It's the essential, often invisible nervous system of the entire data center.
The nervous system. I like that analogy.
It's perfect. They're the synapses, the arteries. They're the ones moving these vast oceans of data around instantly. Think of them like a toll booth operator on the information superhighway.
So any byte of data moving between an NVIDIA GPU or a memory bank or a server, it probably passes through a Marvell chip.
It's the glue,
Yeah.
the necessary glue.
And that nervous system analogy, that is precisely why this deep dive is so critical right now. Because if they're indispensable, then that $77 price tag, it suggests the market might be deeply mispricing them.
That's the big question we're tackling today. Despite this huge cloud of fear, why are expert analysts still seeing pretty substantial upside? I mean, fair value targets are stretching toward $95, even $100.
And maybe more importantly for a fundamental investor, what does it mean when the CEO, Matt Murphy, is out there actively buying shares right now with his own money?
That insider signal is one of the most powerful things we've pulled from the sources. So our mission today is to cut through all that noise. We're going to analyze the sources you shared with us across 7 detailed chapters.
And we're going to determine if Marvell is really a victim of trade wars and cycles, or if it's an essential high-moat franchise that the market is just, temporarily getting wrong because of all this external fear.
Can the nervous system withstand the geopolitical heat? That's the question.
Let's unpack this architecture.
Part 1, chapters 1 to 3. Business, management, and financials.
Chapter 1, Business Understanding.
Okay, so to really get a grasp on Marvell in late 2025, you have to understand its profound mutation. This company has gone through a huge change.
Right, it's not the company it was, say, 10 years ago.
Not at all. It's a story of shedding its legacy skin. It was once, primarily a storage controller company.
And sprawling, lots of lower margin segments kind of bolted on.
Exactly. But now, under CEO Matt Murphy, the company has just ruthlessly streamlined. They've transformed into what our sources are accurately calling a pure-play data infrastructure beast.
A beast. I like it. So what does that mean for their actual model?
Well, central to this whole thing is its operational model. Marvell is fabless.
Meaning they're the architects, not the builders.
Precisely. They design the incredibly complex blueprints, the SOCs, the custom designs, and then they outsource all the heavy capital-intensive manufacturing to foundries like TSMC in Taiwan.
And that fabless model is key to understanding their value, right? It lets them avoid the billions and billions in CapEx needed to build a state-of-the-art fab.
And the payoff is huge. They maintain these remarkable non-GAAP gross margins hovering right around 60%.
That's almost like a software company, not a hardware maker.
It is. And it just confirms the immense value of their intellectual property, their IP.
And that IP is super concentrated where the money is. The cloud.
Let's talk about that revenue engine because the concentration is just, it's stark. In the second quarter of fiscal 26, their net revenue was about $2.006 billion.
Okay.
The staggering part is that 74% of that came directly from one place. the data center segment.
Wow, 74%. So three-quarters of their entire business is tied to the hyperscalers.
Amazon, Microsoft, Google, they have intentionally made themselves a highly leveraged, high beta bet on AI and cloud spending.
Which explains why the stock reacts so violently to even a rumor of a slowdown in server investment.
Absolutely.
Okay, so we know where the revenue comes from. But what specifically are they selling into those data centers? The sources break it down into three critical buckets.
They do. And each one solves a really fundamental physical problem that comes with AI at scale. The first, and maybe the most important, is electro-optics.
The optical supercycle.
Exactly. And you have to ask, why does this matter? Well, it comes down to physics. Transmitting data over old-school copper cables, it just breaks down at the speeds AI clusters need now.
800 gigabits per second, and now we're talking about 1.6 terabits.
Right. At those speeds, copper just generates too much heat, it adds latency, the cables get thick and unwieldy, it just doesn't work.
So the solution is to convert those electrical signals into pulses of light photons and shoot them down fiber optics.
And that translation layer is where Marvell dominates. They lead the industry in the critical digital signal processors, or DSPs, and this whole thing hinges on a technology called PM4 modulation.
Okay, PM4. Pulse amplitude modulation, 4-level.
Yes, this is where you really start to see the depth of Marvell's moat. See, old data transmission was basically sending a 1 or a 0.
On or off.
Right, NRZ signaling. But PMN4, it encodes 2 bits of information into 4 distinct voltage levels. So it effectively doubles the data you can push through without increasing the bandwidth. It's an incredibly complex piece of engineering.
And that massive $10 billion Inphi acquisition back in 2021, that's what locked up their dominance in providing those PMM4 DSPs.
It was the key move.
Yeah.
Without those chips, these sprawling AI supercomputers would literally choke on their own data. This isn't a nice to have, it's a physical necessity.
Okay, so that's bucket 1, speed. What's bucket number 2?
Bucket number 2 is custom silicon, or ASICs, application-specific integrated circuits. This is the next huge growth area for them.
So as the big hyperscalers, Amazon, Google, Microsoft, get so big, the off-the-shelf stuff just isn't efficient enough for them anymore?
Exactly. They need chips tailored for their exact workloads to get maximum efficiency and minimum power draw, a bespoke product.
And Marvell has positioned itself as the design partner of choice, kind of like the expert arms dealer to these giants.
That's a great way to put it. They don't sell the final logic, the customer's secret sauce. They sell the crucial proprietary building blocks.
The IP blocks, like pre-verified memory controllers, I/O logic, that kind of thing.
Right. And the customer then integrates their own secret AI logic on top. They call it the accelerated infrastructure strategy, and the genius of it is how sticky it is.
Because once Marvell's IP is designed into, say, Amazon's Trainium chip, ripping it out would be an engineering and financial nightmare.
Exactly. It creates these incredibly high switching costs, locking Marvell in as a partner for the whole 3 to 5 year life of that chip.
Okay. And the third bucket?
The third bucket is storage and networking. This is their legacy business, but it's a cash cow. Think hard disk drive controllers, Ethernet switches.
Still important, but less glamorous than the AI stuff.
For sure. But they have a duopoly with Broadcom in HDD controllers. And even with flash storage taking over, mass cloud storage still relies on spinning disks, so it provides a nice stable base of revenue.
And that strategic clarity, that focus, is really reinforced by their moves. Specifically, selling off the automotive Ethernet business.
Yes, in August 2025, they sold that for about $2.5 billion. And the sources frame this as a really smart, almost Buffett-esque move.
Pruning a healthy but non-core asset to just hyper-focus.
Exactly. The auto business was growing, but it had lower margins and these really long, different sales cycles compared to the hyperscalers.
So by selling it, they clarified their strategy and freed up a ton of cash.
Right, which they used to pay down debt and fund that huge buyback program we'll get to later. It just screams disciplined management.
So this brings us to the moat.
Yeah.
What stops Amazon from just building this nervous system themselves? The sources call it engineering density.
But engineering density, it's a capital barrier, really. We're talking about designing chips at the absolute bleeding edge 3-nanometer nodes.
You can't just disrupt this with a few smart engineers in a garage.
No way. It takes hundreds of millions in software licenses, a huge library of specialized IP, and decades of engineering talent.
So Marvell is basically selling speed, time to market.
That's it. A hyperscaler could try to build these complex IP blocks from scratch, but it would take them, 3 or 4 years?
And millions in R&D.
Or they partner with Marvell, license their pre-verified IP, and get to market in 18 months. In the AI race, getting there 18 months faster is priceless.
That's the competitive advantage.
Yeah.
They own the interconnect toll bridge. And it's built on a few pillars. We touched on switching costs.
Right. Once they're designed in, they're in for years.
Then there are the intangible assets, the patent portfolio.
And again, you have to go back to that $10 billion Infi deal. Critics said it was too expensive at the time.
Today, it looks like a masterstroke.
It does, because it secured the patents on how to do PAM4 modulation, how to move data over fiber at these insane speeds. It's incredibly hard to work around that.
And there's a third pillar, kind of a network effect in custom silicon.
Yes, the more custom chips they design for AWS, Google, and Microsoft, the better their underlying IP library gets.
So every problem they solve for one customer makes them a better partner for the next one.
It's a virtuous cycle, and the financials really bear this out. Management has said that their earnings growth rate was more than double their top-line revenue growth.
Which highlights that operating leverage you mentioned.
It's proof that the model is scalable. As they grow revenue, a larger percentage of every new dollar flows straight to the bottom line. That's the hallmark of a really high-quality business.
Chapter 2, Management Evaluation.
You know, a transformation like the one Marvell went through, it always comes down to leadership. You have to look at Marvell before and after 2016.
Okay, what was it like before?
The pre-2016 era was founder-led, and frankly, it was characterized by stagnation, a messy product portfolio, even some accounting scandals. It was just unfocused, underperforming.
And then Matt Murphy comes in 2016, the transformation agent.
He really executed a textbook turnaround, pivoted them from that sprawling commodity chipmaker to a highly specialized, high-performance boutique, just relentlessly focused on data infrastructure.
He realized they couldn't win by selling everything to everyone.
No, they had to be specialists in the hardest parts of connectivity. And his tenure is really defined by this aggressive and I'd say prescient M&A track record.
These weren't just deals to get bigger. They were strategic land grabs for future tech.
Exactly. Let's run through them. First was Cavium in 2018 for $6 billion. That was the first big move up the value chain, away from legacy storage.
Then came the big one, Infight in 2021 for $10 billion.
And we have to frame this correctly. This wasn't just another acquisition. This was Matt Murphy's preemptive, contrarian, bet the company moment.
A huge stretch for them at the time.
It was. A lot of critics said he overpaid. But he saw this optical bottleneck coming years before the AI boom made it obvious to everyone. That single decision is why Marvell is so central to the AI story today.
That's really crucial context. It shows real vision. He paid a premium to own the industry standard for the shift from copper to light.
And finally, Innovium in 2021 for $1.1 billion. This was more of a tactical move.
Bolstering their switch silicon portfolio to go head-to-head with Broadcom.
Right, specifically targeting customers who felt, let's say, constrained by Broadcom's offerings. It gave them another angle of attack.
So we have a CEO who is strategic, visionary, and can integrate these huge companies successfully. But the real test is capital allocation, especially now with the stock beaten down.
And the focus is overwhelmingly on R&D. They are spending aggressively over $500 million a quarter to stay ahead of Moore's Law and, frankly, the design teams of their own customers.
Where's that R&D money going?
That's the key. Over 80% of it is directed specifically at those high-margin data center initiatives. They are pouring fuel on their growth engine.
And beyond innovation, they seem focused on shareholder returns right now. The board just authorized a massive $5 billion stock repurchase plan.
That is a huge signal. Relative to their, $70 billion market cap? That's almost 7.8% of the company.
And with the stock so depressed, it's a very powerful lever.
It is. It tells the market we think our stock is cheap, and it actively helps reverse some of that dilution that was necessary for those huge acquisitions.
Okay, that sounds good, but let me push back a little. You gave them an A for management. The dilution from those deals was massive, and they still have a lot of debt. How meaningful is a $5 billion buyback, really?
That's a fair challenge, a necessary one.
Couldn't that capital be better spent trying to speed up that 2028 domestic manufacturing timeline we know is a huge risk?
So the A is contingent on that big Infi bet paying off, which it seems to be. As for the buyback, it addresses the dilution problem and provides a financial floor under the stock, which helps EPS and helps the stock re-rate. The R&D, the $500 million a quarter, that's what's accelerating the technology moat.
So they're separating those levers.
Right. And speeding up domestic manufacturing. That's largely out of Marvell's direct control. That needs government subsidies, TSMC's timeline, construction schedules. So given those constraints, Using the cash for buybacks and paying down debt is arguably the best thing they can control right now to create value.
That makes sense. They're focused on what they can execute on immediately. And that ties right into the final signal, the insider buying.
CEO Matt Murphy recently bought 13,600 shares at around $80.
That's the ultimate confirmation, isn't it?
It is. When the market is terrified and the stock is 40% off its highs, the CEO is putting his own money on the line. Insiders sell for all kinds of reasons. Taxes, diversification. They only buy for one reason. They think the stock is going up.
Chapter 3, Financial Health.
All right, let's ground this whole story in the numbers. Marvell has a $70.1 billion market cap, trading at $77.45. The headline here is just acceleration.
The pivot is clearly working. The latest revenue figures, Q2 fiscal 26, total revenue grew a staggering 58% year over year to over $2 billion.
That is not the growth rate of a mature semiconductor company. And the core data center segment, it grew even faster, 69% year over year. The AI bet is paying off and it's dragging the whole company up with it.
Okay, now we have to talk about the margin gap. This is something that confuses a lot of investors. The difference between their non-GAAP gross margin, which is high at 59.4%, and their GAAP gross margin at 50.4%.
That's a huge gap, nearly 900 basis points, and you have to unpack it.
It's mostly driven by two big non-cash items, right?
Exactly. First is the amortization of intangible assets from all those big acquisitions, Inphi, Cavium. Basically, the value of the IP they bought gets expensed over time on the GAAP income statement.
And the second one is stock-based comp, or SBC.
Right, which is not a cash cost, but it is a real cost to shareholders because it causes dilution, so you always have to factor it in.
But even with that gap, the trend is what matters. Non-GAAP operating margins expanded by a whopping 870 basis points year over year to almost 35%.
And that massive expansion is the tangible proof of their operating leverage. Costs are rising much slower than revenue. The model is working.
So what about the balance sheet? How stable are they?
Strong. That $2.5 billion in cash from the automotive sale gives them a really crucial liquidity buffer.
And the debt from the acquisitions?
It's manageable. The debt-to-equity ratio is about 0.33. And critically, they are generating a lot of cash, almost $462 million in operating cash flow in 1 quarter alone.
So they are free cash flow positive, which is a huge distinction from a lot of tech growth stocks that just burn cash.
They're self-funding their R&D and their buybacks. It's a healthy business.
Okay, so now the tough part, valuation. Is Marvell cheap at $77?
It's tricky because they're in a cyclical sector, but they're showing hyper-growth characteristics.
If you look at the forward PE, it's around 27x. That's a pretty big discount to their main peer, Broadcom, which is closer to 37x.
It is. Broadcom gets a premium for its software business and its dividend, but Marvell is growing revenue and earnings way faster.
And that faster growth is where the opportunity is.
Absolutely. If you look at the PEG ratio, the price earnings to growth, it's likely somewhere between 0.5 and 1.0. And anything under 1.0 is generally seen as a sign of undervaluation for a growth stock.
So the market is clearly pricing in a huge discount for all the risks we've been talking about.
Exactly. And from an intrinsic value perspective, the high volatility makes DCF models tricky. The stock's beta is really high, about 1.93.
Meaning if the S&P 500 moves 1%, Marvell tends to move almost 2%. It's a wild ride.
And that high volatility drives up the risk perception, which means investors demand a higher return. That pushes up the WACC, the weighted average cost of capital, to about 11.3%.
Which, in turn, pushes down the perceived present value of future cash.
Right, but even with that high discount rate, if you believe they can keep growing the data center business at 30-40% for a few years and expand margins to their 38-40% target, the cash flows are massive.
So the analyst consensus, factoring all that in, lands somewhere around $91 to $94.
Which implies a nice 20% upside from here, but the real question is your margin of safety. Is the AI build-out a lasting industrial revolution or a short-term bubble? Your answer to that question determines everything.
That's the wall we have to break through. If it's a revolution, $77 is a bargain. If it's a bubble, it could still be expensive.
All right, we've laid the foundation. Now let's tackle the fear head-on.
Part 2. Chapters 4 to 7, market sentiment, ownership, risk, and final conclusion. And before we dive into the market's very jittery mood, a quick word for you, the listener. Like and subscribe to Stock Analytics AI. For $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives. Chapter 4, market sentiment.
As of late November 2025, the emotional state of the semiconductor sector is Neurotic. That's the only word for it. It's dominated by these two big anxieties.
The AI fatigue we mentioned earlier.
Right. Investors are getting impatient. They want to see the revenue now. And then there's the Trump trade fear, the very real threat of 100% tariffs.
And that mood is driving this volatility that seems totally disconnected from Marvell's actual results.
We saw it just recently. November 20th, Marvell dropped almost 6% in one day. No company-specific news. It was all just broad tech and tariff fears.
Even NVIDIA slid after beating earnings. It's a sign that macro fear is just overwhelming everything else right now.
It is, and this uncertainty has led to this huge, confusing split among analysts. The price targets are all over the map, from a low of $58 to a high of $149.
That's a massive range.
It is. The bulls, like Raymond James, they have a strong buy and a $121 target. They're betting on the optical supercycle and the strength of the IP.
They believe the tech is so good it can overcome the macro headwinds.
Right, but then you have caution from analysts at Barclays who downgraded to equal weight. They're skeptical that Marvell can keep hitting these super aggressive growth goals every single quarter.
So the debate isn't about the quality of the company, it's about execution risk.
Exactly. And the technical signals are pretty mixed, which suggests we might be getting close to a temporary bottom.
The stock is trading below its 50-day moving average, which is a bearish signal.
It is. That's at about $84. But on the other hand, the RSI, the Relative Strength Index, is hovering near 40.
Getting close to that oversold territory below 30.
Right, which suggests the selling pressure might be getting exhausted. We could be set for a rebound if the earnings report in December is strong.
What about short interest? Is smart money betting against them?
It's moderate, about 4.3% of the float, which is actually a reassuring sign.
It means the big players aren't making a huge bet that the company's going to fail.
Exactly. But it's enough that if there's a positive earnings surprise, it could fuel a small but sharp short squeeze, driving the price up quickly.
Chapter 5. Ownership Structure.
You know, it's important to understand who owns this company. Marvell is fundamentally an institutional darling. This isn't a retail meme stock.
So its stability comes from being owned by the biggest, most patient money managers in the world.
That's right. We're talking huge stakes. Vanguard owns 23.5% of the company.
23.5%? Wow.
And then you have BlackRock and Fidelity holding another 6%. These are long-term holders. They move slowly, and that provides a real foundation for the stock.
But that stability is a double-edged sword, isn't it? It's also a huge concentration risk.
It is. If some big geopolitical event, like those tariffs actually happening, causes these big funds to just rotate out of the entire semiconductor sector.
The selling pressure would be immense.
Relentless. If they decide to reallocate even a small part of their holdings, it could just crush the share price.
And this is where we have to circle back to that insider buy signal.
It becomes even more important in this context. You have all this institutional money getting nervous about macro risk, and then you have the CEO, the person who knows the business best,
Telling the market, I see the risk, but the underlying value is so good, I'm betting my own money on it.
It's a powerful psychological anchor for an individual investor.
Chapter 6. Risk assessment.
Okay, let's summarize the whole risk profile using a quick SWOT framework before we get to the elephant in the room.
Go for it.
Strengths are pretty clear. The IP leadership in optics, custom silicon, aligned management. Weaknesses, the gap loss from SBC, and that heavy customer concentration.
Right. Opportunities. The custom silicon market is expanding, and that $5 billion buyback provides a floor.
Yeah.
And the threats.
The threats are what's dominating the story. The geopolitical tariff risk and the vulnerability of that Taiwan supply chain.
So let's focus on that elephant. Geopolitical risk. This is the single biggest factor weighing on the stock right now.
It is. The core of the risk is the proposed 100% tariff on imported semiconductors.
And the bluntness of that proposal is what's so terrifying for a fabless company like Marvell.
Because they rely almost completely on TSMC in Taiwan. If that 100% tariff happens, based on where the wafer is processed, it would instantly double Marvell's cost of goods sold.
Double their COGS. I mean, their gross margins would be just wiped out.
They'd go from nearly 60% to single digits, or even negative. They'd have no choice but to try and pass that cost on to their customers.
And even Amazon and Microsoft can't just absorb a doubling of chip prices. It would destroy demand.
It would. And it all speaks to this underlying supply chain vulnerability. They are utterly dependent on TSMC. Any disruption in the Taiwan Strait, blockade, and escalation, it would just sever their supply entirely.
That is an existential risk.
It is, and the industry is scrambling to mitigate it. TSMC is building fabs in Arizona. Amkor is building a huge $7 billion packaging facility in Arizona.
Which is critical for a secure, end-to-end domestic supply chain.
Yes, but the timeline is the killer. The Amkor facility, which they need for that final step of packaging the chip in the U.S., it's not expected to start production until early 2028.
2028.
Which leaves this massive exposed 3-year window where Marvell is just extremely vulnerable to political trade shocks. They have no domestic fallback at scale.
And that 3-year window is exactly what the market is pricing in at $77. The risk isn't theoretical, it's imminent.
One less risk to touch on. Customer concentration and cannibalization?
Right. Relying on Amazon, Google, and Microsoft is great when they're spending, but they're also building up their own internal chip design teams.
Like Amazon's Annapurna Labs. Marvell is their design partner now, but the long-term risk is that these giants learn enough to eventually cut Marvell out completely.
So Marvell's only defense is to just keep innovating faster than their own customers can.
They have to stay 18 months ahead. Always.
Chapter 7.
Conclusion. All right, let's pull all of this together. Marvell Technology is the classic pick-and-shovel play on the AI gold rush. They sell the critical tools.
They have a wide, defensible moat built on that optics IP and their custom silicon expertise. They sell products that are indispensable.
The financials are strong, growth is accelerating, and they have that powerful operating leverage. Management is aligned, as shown by that huge buyback.
So the current price, $77, is really a function of this acute macro fear. It's masking the reality that their core business is growing at nearly 60% year over year.
They are, without a doubt, the indispensable architect of the AI nervous system.
So let's run through the 3 possible paths forward, because so much depends on how these geopolitical risks play out.
Okay, the bull case. The custom silicon and optical supercycle thesis just executes perfectly. Tariffs are avoided or mitigated. Margins hit their long-term target of 38–40%.
In that scenario, the stock easily re-rates to a premium multiple, back to $120 or higher.
Then there's the base case, which is probably the most realistic. Steady data center growth continues. The tariffs create some pressure, but the buyback program provides a strong floor for EPS.
So the stock just kind of grinds its way higher towards that fair value of around $95, and the market gets more confident.
Exactly. And then there's the bear case.
The tariff nightmare.
Broad 100% tariffs get enacted. Marvell's COGS double, margins collapse. At the same time, hyperscalers cut their AI spending. In that world, the stock could easily revisit the painful lows in the $40.
So what's the final verdict?
Our final verdict, based on a conservative intrinsic valuation, even with that high 11.3% WACC to account for the risk, suggests a fair value of $95 to $100.
So the current price of $77 offers a compelling margin of safety, about 20% below that intrinsic value.
Which presents a pretty attractive risk-reward profile.
So the actionable verdict is a decisive buy,
Yeah.
but with a big caveat.
A huge one. This is a purchase for the patient, conviction-driven investor with a 3 to 5 year horizon. You have to be willing to weather the sharp, volatile, geopolitical headlines that are going to dominate the news between now and that critical 2028 timeline.
The patience is absolutely key. The fear around the Trump trade is creating the entry point, but you have to be emotionally ready for the ride.
And as we wrap up, we'll leave you with this final thought to chew on. Is this current geopolitical volatility just a temporary distraction that's letting you buy a great company on sale? Or does that 3-year gap until the Amkor facility comes online mean the tariff risk is actually still profoundly underpriced by the market?
Something to mull over as you do your own due diligence. Thank you for joining us for this deep dive into Marvell Technology. Like and subscribe to Stock Analytics AI.
And remember, this analysis is based solely on AI research compiled from the sources provided as of November 22, 2025, and it is for informational purposes only. This is not personalized financial advice. Investing in semiconductors involves significant risk, and you must always do your own due diligence before making any investment decision.
We'll see you on the next deep dive.